It's time now to catch up with Venugopal Garre, the managing director at Barnstein, joining us to talk to us about the fundamentals of the market. Venugopal, hi, morning. Thank you so much for making time and speaking with us. First up, let's start by talking about the market outlook itself. We have seen quite a bit of rally from March lows, almost a double-digit rally in Nifty already. Do you see it trending higher, or a bit of consolidation is on the cards?
Yeah, thanks a lot. Broadly, if I look at the way we have been looking at the market, we sort of upgraded the equity view in the first week of April. Perhaps that was the time when the market was closer to 17,000 Nifty. Now, since then, the increase has been fairly swift, and at this juncture, we are broadly taking an opinion that we should ideally head from a large cap sense, which is a top-down Nifty index, perhaps should consolidate at these levels, which is more a time value correction rather than an absolute correction. And a part of that thinking is when we upgraded India, our thinking was fairly simple that macro has to a large extent bottomed out then, and not just the broader macro parameters, things like current account deficit outside of that was showing sort of strength, which meant that even from a currency standpoint, perhaps it would have been more stable. And more importantly, broader sluggishness in China, which was another variable which we felt would bring in foreign flows into India. Now, to a large extent, all of that holds good even now. Nothing much has changed. It's just that valuations have increased quite rapidly. So what we are saying is that outside of the Nifty index, there would probably still be a broader strength in the market, which is the smaller stocks, because it's actually quite easy to justify those because they're relatively higher growth in any case. So you can play that valuation story for a while, till everything peaks. So that's like the broad view right now. I mean, there are some risks which we can discuss, in terms of those are risks which sort of cap upsides beyond the stage.
Okay. Hi there, morning. Wanted to also get in your outlook then on the entire IT sector, given the given the fact that, of course, we're anticipating the big ticket numbers that will be coming out this week itself. How are you looking at how the Indian IT companies stack up in terms of valuations? Is there that distinct line between the large versus the mid caps?
Yeah, so see, the broader thinking for us at this juncture is if you look at the outlook on exporters in general, which includes IT, it's not really that great. So I think that is the more important thing is it's actually known. So there are nothing called hidden strategic surprises that you're going to basically see in numbers. The reality is that things are going to be generally sluggish. So don't really expect any sudden positive surprises to come up. They should not. Which primarily means that numbers wise you'll probably see some weakness. There's always this risk of outlooks also getting revised down marginally or a bit. But at the same time, I would probably argue that valuations, from levels that they were about 1.5 2 years back have substantially come down to a large extent. So our view is that it is perhaps still logical to play IT selectively. We are playing it with one or two stocks, but the idea is that this would still be under the category of so-called contrarian bets, because if you were to get your next alpha over the next 12 months, perhaps at some stage this is going to bottom out. Because broadly, if you look at US as an economy, it is still relatively strong. So it is not that it is going to go into a deep recession. Plus this entire thing around AI, which in our views, IT services will be a beneficiary. And at some stage, people would start linking AI with IT services when they run out of ideas, in the frontline AI place, which is, all the semiconductor companies. So watch out for that, I'll probably say.
Right. Venu, how do you now dissect within the banking and financial space? Because clearly promoter-driven NBFCs we've seen have excelled. The market as well as rewarded the stock price performance. Large banks like Axis, ICICI, and now HDFC Bank, all the adjustments behind. And clearly, they've been winners across all metrics. But surprisingly, it's actually the PSBs wherein you still find some value on the table, and they have seen some outperformance as well vis-a-vis the market performance. Is that the place to bet on, or would you stick with the large NBFCs and large large private banks?
Yeah, I mean, this is this question, I was trying to broadly address more about thinking about risk levels in the system. Now, if risk levels in the system are relatively lower, by which I'm primarily saying that credit quality perspective in general, things are pretty okay with the economy. And it's also because we are early cycle in some way, and all the challenges to a large extent have been cleaned up in the past. So when it comes to a recovery mode, which is not like a 1-2 month thing that we look at for financials, it's more a cycle, or let's say a 3-year bucket of a cycle. My view is that financial sector contribution to, let's say, the top performers has to increase period of time. This will by far be still the most important sector, because a lot of economic recovery, I guess, would also be driven by leverage. I think that's one of the thesis of why macro should, sort of see a cycle. So leverage driven cycle is going to only happen if financial sector is willing to lend. And I think they are starting to be comfortable in willing to lend. So it's a overall positive view on credit growth over a 3-year view, which primarily means that you have to broaden your horizon around what to buy and what to sort of get out of. And I think if at all you see risk, would be individual banks. If you're not comfortable with promoters, will ideally you would anyways put those aside. But then apart from these frontline banks, we have generally been open to SOEs as well, even though I tend to avoid them. So one of the largest SOEs or the public sector undertakings, we have it in the India portfolio, which is actually a rarity. It is just a representation of the fact that we want to broad-based. See, some NBFCs have really swiftly moved up, that you've seen, I guess, as soon as the interest rate peaking happened, right, from an RBI policy point of view. So I guess that was a trade, so you'll probably see some correction before things move up.
Right. What about autos, Venu? I mean, are they close to anywhere peaking out? I mean, we've seen the performance and the commentary from Tata Motors. Now they're saying, JLR is expected to report positive free cash flow of over about 400 million pounds in the first quarter. We've seen all those new launches coming in from the entire two-wheeler stable, and, the fear around what it would do to Aisha's dominance. And then look at M&M. I mean, in just the last 1 year, the stock price has already doubled. I'm not asking you stock specific, but just overall your thoughts on the auto pack.
See, auto, we have generally been positive. Unlike the consumption space outside of autos, where things like FMCG were not very positive, and there were very valid reasons not to be positive on FMCG or broader discretionary outside of autos. See, autos had momentum primarily because of two things that was very, very clear at top-down level. One is passenger vehicles CAGR last 3 years, or I would say pre-COVID until now, is probably around 4%. Two-wheelers are still sitting at absolute volumes which are below pre-COVID levels. So very clearly we are not peaked out. We are moving through a positive cycle. Similarly, from a margin standpoint, you've seen commodities basically moderate significantly, and price hikes have already been taken. And now commodities have started to moderate, at least in the last 6 months. So that's going to be positively impacting margins. So we've not yet peaked, that's the way I would look at it. But at the same time, we would run out of ideas at some point of time. So the frontline PV players, which includes the names you mentioned, the 3 companies basically which are associated with PVs or tractors, they are anyway something that we like. Of course, 2 of them are, covered stocks, which we like. The two-wheeler names we have still, very individual bets in terms of what we take, because we don't want to be eventually, caught in a sudden situation where, EVs pick up and somebody loses quite materially. So they're being very selective about it. Similarly, at the same time, the premium launches which are happening, of course, is going to be impacting one of the companies which is a premium player, but at the same time, it's going to support, the new companies which are entering that space. But then the question simply is, which of those really focus very hard to make that as an important space for themselves is very important. Just one launch itself is not enough. You need to take that as, a very holistic approach towards how you distribute the product and what is your next pipeline. So that's an area that we would be focusing on next. But one of the two-wheeler companies, which is the largest market cap ones within those 3 or 4 important ones, is something that we like and we have an overweight.
Well, yes, one swallow does not a summer make. That's the line which you should use for all of these auto companies. We'll have to see those slew of launches rather than just one, depending on one. But Venugopal, what's your take regarding a lot of these new age tech companies, Zomato, the likes of Paytm, PB Fintech, Delivery, etc.? I think the dark clouds regarding the lack of path to profitability are now going away, and the valuations too have become a lot more comfortable?
Yeah, so we actually were on the sidelines from an India perspective on consumer tech, from a strategy portfolio perspective, all through of last calendar year. We upgraded consumer tech in January to overweight, and so which primarily means that we were fairly comfortable with the trajectory in terms of the path to profitability. Now, at any point of time, even if you look at valuations today, they would still look very costly relative to the world. And we had to actually take pretty much India-specific calls and take a call on both growth as well as business model changes that some companies have actually done, and whether they can actually sustain or generate profitability, at least in that path. So from that sense, we actually like consumer tech space, and there are specific companies, of course, some of them have mentioned that we actually have overweights on. So food delivery, for example, is an area that we have positioned in our portfolio. Similarly, commerce logistics, we're positioned in a portfolio. But I would probably just warn that this is still an emerging space. So there could be intense volatility, so we have to live with that volatility. But where they are in terms of levels compared to where they were an year back, you still have downside cushion. Probably that is the only thing that supports a thesis right now.
Okay, fair enough. Meantime, also wanted to understand your outlook on asset allocation because, you've spoken about, the outlook as to how in the report, how one should look at various asset classes and the strategies in a market like this. If you could just briefly expand on various other asset classes, what the outlook is?
Yeah, so I was running out of some of these frontline large cap equity ideas, let me be very honest. So I ended up in the portfolio taking a 20%, sort of weightage to SMID index because of the lack of individual companies, that we had coverage on SMID. So I wanted exposure to SMID to play that, sort of flow momentum. Similarly, from a point of view of global perspective, there are three things which matter, right? Which is fixed income, gold, as well as something like a crypto, which is an emerging asset. So we didn't really overtly put anything in fixed income this side, but at the same time, what we did is we ended up taking a short position on gold and taking a slightly long position on Ethereum. Now, this primarily is a very interesting thing because this to some extent means we are taking a risk on view from a global perspective, which is primarily meaning that we're not going to see any of the financial sector distress that we saw in the US a couple of months back or early this year, which led to, sort of people sort of moving into gold as sort of as a hedge. I think it's a very, very costly asset at this point of time. So that's why we thought we should introduce a short on gold. That's a view we've been holding for the last 2 months. It's just that we added in the portfolio.
I just want to scratch the point that you first made, that the market does run some risks. What risks were you alluding to?
See, if you look at monsoons, it's been very patchy. So that sort of does worry me a bit. I mean, the overall headline numbers doesn't matter because a lot of regions where monsoons essentially have been sort of below expectations. So and plus not just that, if you look at this volatility around vegetable prices, which does lead to, sort of impacting the budgets of the middle and low middle class. That's another aspect which sort of worries me on the consumption side. The second aspect, which is important, is look at the India earnings story. See, the India earnings story is not a top line story. I'm pretty sure you would have heard that it is more a margin story for a lot of sectors. And that is actually being driven through the fact that commodities have been pretty much in control. But the perspective is, I'm basically saying we're not heading into a deep recession globally. China is sluggish right now, but if it sees a semblance of recovery, if commodities actually go up, which is both crude and other commodities, that could sort of spoil the story, right? So that's the second aspect that I worry about. The third thing is, at this juncture, we are more or less in our view that we are not going to see any rate hike anymore in India, right? In fact, people are talking about when the cut will start. Now, Fed has clearly signaled that they would probably be hiking more through the year, right? Which is primarily meaning that India would have to take a call on how much gap we want to keep with Fed rates. Because then, I mean, we are in an okay situation as far as reserves and current account deficit is concerned. So we may not see too much rupee volatility. But let's say 3 hikes, 4 hikes, and we're talking about 2 more hikes for Fed, but let's say more than that. Then how does India react? That's all a question of how US inflation shapes up and how sustainable, it is in terms of its decline.
Okay, and just before I let you go, you are positive incrementally on consumer tech, but I don't see many consumption or the FMCG or even consumer durables, etc. in your portfolio. Is that a conscious avoid?
Yeah, I mean, honestly, FMCG, I didn't want to. Too costly, has already traded up. There's no positive surprises that I see. You're seeing some updates as well, right, from companies like Marico. It didn't look that great. The second thing is probably argue that consumer durables was not a conscious sort of a thing. We are broadly of the view that things are not that great at this juncture. At some stage, we would probably pick individual stocks there, especially given the unseasonal sort of rains which happened, sort of did cloud or impact sentiment in terms of volumes this quarter. But ideally, that's a space which is linked to real estate. So if I were to take a 12-month view, I would want to add stocks in the consumer electrical durable space.
That's quite interesting. Venu, great to have you on the show as always. Thank you for taking the time out.